Hey Glenn, it's great to meet you. I know you guys have been doing a lot of stuff at West Red Lake. Would love to know a little bit about yourself. And I know that you recently had the transition over to West Red Lake. So how has that been?
Absolutely. So my name's Gwen. I just joined West Red Lake Gold Mines as the Vice President of Investor Relations. Big change for me. I spent 10 years running my own business, trying to help investors find the best investment opportunities in the mining space as a whole. Then I found West Red Lake, visited it as an investor a year ago, owned the stock, and just now have had the opportunity to join the team. So why did I close my business that I'd spent 10 years building to join this company? It comes down to the asset that we have, the Madsen mine, was built not very long ago, only a few years ago, by a previous management team who lacked some of the operational expertise that was needed. They made a few trips on their mine building process. They also made some mistakes in how they financed the mine, and the whole thing ended up going bankrupt. That created the opportunity that is West Red Lake Gold today. So we were able to buy that mine for literally pennies on the dollar that had been invested in the mine. And we have the management team that has deep mine building and operating expertise. So we have analyzed the situation, we've identified the things that need to be changed at the mine, and we are implementing those changes so that we can turn this mine on in the middle of next year. The best way in the mining space to make money is to play what we call the golden runway. When you transition from spending money, like building a mine, to making money by producing gold, West Red Lake Gold is an accelerated golden runway because we are going to turn this mine on in about a year. A lot of the capital is already spent, and it's just a really exciting time for me to join the team.
So you guys did get really lucky with how you were able to actually take over that asset at such a low cost. How did you guys get in the room for that deal?
How did we get in the room to be able to buy the Madsen mine? It's a good question. Lots of companies were interested in buying the Madsen mine. What it really came down to is Pure Gold, the previous operators, had gone bankrupt, and the asset had gone into the bankruptcy process. Therefore, it was owned by the lender, which was Sprott Resource Lending. They're the ones who had provided $150 million of debt to build this mine. So Sprott was looking for a deal that gave them the best chance of getting a good chunk of their money back. From what we understand, lots of other offers were tabled, but a bunch of them were just money. But if they're just money, then the return for Sprott was capped. That was the amount that they were going to get back. West Red Lake Gold Mines came and offered a cash component, but also a significant equity stake. So Sprott Resource Lending is now a 24% shareholder in West Red Lake Gold Mine. They made the choice to go with our deal because they see the potential for those shares that they own in our company to increase in value as we put this mine back into production, go through this golden runway, and become an operating gold mine company.
We're at the 99th yard line, as they say.
Yeah.
But what does that really mean in terms of a time frame? How much would I have to wait for another company to get to where you guys are?
So Frank Justra is the backer of this deal. He was the first backer. He was backing us buying this asset and us as a company. That resonated with a lot of people because what Frank does is he's very good at identifying moments in the gold market. He sees this as a new gold bull market. And the way that he rides those gold bull markets to great success and has become very successful doing that is by getting to production quickly. And so people say Frank takes broken assets and makes them work. That's because taking a broken asset and making it work, if you can do it, sidesteps the very long time frame that is otherwise always required if you want to put a mine into production. Because what does it take to put a mine into production? You got to make the discovery. You got to drill out the discovery to an inferred resource, sort of confident. Then you got to make it into a confident resource. Then you have to build a mine plan around it. Then you have to put a lot more engineering into that mine plan, make it a confident mine plan. All along the way, you have to do permitting. Permitting in a lot of jurisdictions, at the very fastest, is a 2-year process. It can often be a 5 or 6 year process to get a permit to build a new mine somewhere. And you have to raise all of the capital. Then you have to build the mine. Just building a mine, once you've done all of that work, from the construction decision, is often a 2 to 3 year process. So we have the previous operators did all of that legwork. They invested $350 million. They got the permits. They did the engineering. We're redoing some of that engineering work, but we have the permits, we have the tailings facility built, the mill is built, the underground development is largely in place. So we are confident in saying that in the second half of next year, so in roughly a year, we're going to turn this mine on. So that is a very accelerated pathway to production.
What do you think went wrong?
Yeah. A really important question when you're trying to understand the West Red Lake Gold story is what went wrong with the prior operators and why do we think that we can fix those things? I could spend a long time talking about this. To summarize it, the prior operators approached this asset with a mind frame that they wanted to sell it. This group had had a lot of success selling several companies or assets previously. None of those assets had gone to the construction phase. So they had done a really good job of identifying geologic opportunities, making discoveries, growing those discoveries, maybe wrapping a very basic mine plan around them, and then selling that potential to an experienced mine building and operating company who would then build the mine. What they did here was they ended up building the mine. They actually did too good a job marketing the opportunity. The share price got ahead, you might say, of the value of the asset. And then all of the companies that might have been interested, that were interested in buying the asset, weren't willing to buy it for the price that the market had sent it to. So this inexperienced management company, they're good at capital markets, but didn't have enough operational and mine building experience, ended up building the mine. In that, they did it with not enough capital. Again, they wanted to be appealing to potential acquirers, so they didn't want to have that much debt on the books. So they squished the amount that they were spending on building the mine to as little as possible. So they were building the mine with not enough capital and not enough expertise. To give you some examples of what that resulted in, they didn't do enough infill drilling. This is Red Lake, Ontario. There is very high-grade gold in the ground in Red Lake, Ontario, but you have to know your ore body intimately, which means you probably have to do 6-meter spacing on your drill holes. They had 15 to 20-meter spacing on their drill holes. They just didn't know the ore body well enough. If you have two holes that are 15 meters apart and you assume that it's continuous in between, it probably isn't. It probably does things like this, and then you will lose the ore if you go on an insufficiently informed resource model. So that's something that we can fix. We are doing 50,000 meters of infill drilling on the asset to make sure that we are very confident we have a good handle on the ore body. They didn't choose a very appropriate mining method. They were over breaking. So if you have a narrow zone that has lots of gold in it, but you over break, that means you're also mining the rock beside the ore that has no gold in it. You mix those things together and that's called dilution. So instead of mining 8 gram per ton material, you end up mixing it with 0 gram per ton material. Maybe you come out with 4 gram per ton material. If you're taking rock to the mill, costs the same amount to move the rock, but it only has half the amount of gold in it, that isn't gonna work. So they also didn't do things that were needed on a capital investment basis that impacted efficiency and increased operating costs. So they didn't connect the two sides of the underground mine, which meant that there was congestion, trucks were getting in the way of each other. They didn't buy some of the things that are essential to an efficient mine, like a primary crusher, like a camp to house people. Instead, they leased a primary crusher for a lot of monthly operating cost, and they housed people in hotels all over the nearby city. Again, lots of operating costs. So the ore was getting diluted. They weren't bringing enough gold to the mill because of those mining mistakes. And then their costs were way higher because of some of their operating mistakes. You put those things together and then you layer COVID on top and it didn't work out. But those things are all fixable. Those are all the fixes that we're implementing right now.
That's fantastic. So when you're looking at the next year, what are some of the things that you guys are spending a lot of time focusing on?
Over the next year, there's a lot underway. There's a couple specific milestones that we will be able to announce. And then along the way, we're going to be making a bunch of other announcements about all of the other things that are happening simultaneously. This is a really important point. Most mines get built in a particular order. You define, you engineer, you permit, you put out a study, you finance, and then you build. What we're doing is, since the mine is largely built, We are refining the mine build. We're doing some additional capital projects. We're basically doing the build part that usually comes at the end. We're doing that right now. And near the end of that build part is when we're going to issue the pre-feasibility study that will detail exactly how much gold we're going to produce and what the costs are going to be. So the official study for what the mine is going to look like will come out at the beginning of 2025. But by the time we issue that study, most of the work that's needed to get to a restart decision will be already done or well underway. So the pre-feasibility study will come out. We'll be able to talk about ounces per year and all-in sustaining costs, which is a really important milestone. But by then, we internally will already have a year of stope designed mine inventory laid out. We will already have a lot of the capital projects underway, and we will be getting close to the point where we can truly say, it's time to start mining, and we will turn on the mill and we will be able to start producing.
So is it safe to say that right now you guys are kind of patching up the holes, rebuilding the issues that existed before, and then also looking for possibilities of expanding the existing resource?
For sure. So we're absolutely fixing the things that didn't go well in the first version of the mine build. And that includes certainly making sure that we have a good hold on the mineralization. We're going to do things to test that, like test mining, a bulk sample, a sample tower to do grade reconciliation. Those are all really important de-risking things as we get this thing back into production. They're really important parts of, patching up the errors. But at the same time, we are really excited. One of the big reasons, there's two reasons to get this mine back into production. One of them is to make money. This is a really good opportunity to leverage a strong gold market and make money because there's so much, spent capital here. There's a really good resource. That's the number one reason. The second reason is that when you're inside an underground operating gold mine in a place like Red Lake that is known for high-grade gold continuing to depth, often getting richer at depth, the way to take advantage of that potential opportunity to find more and maybe get bigger is to be in the mine. And then you can look around. You have the money and you're in the place where you can look around and see if you can find more. So even as this year progresses, before we're really in operation, we're going to get down there. We're going to start drilling some of the zones that we're really excited about the potential to add them into the mine plan, like the 8 zone, which is at the bottom of the shaft that already exists and has a resource that is much richer. The resource in the main zone averages 7.4 grams per ton. The resource at the bottom of the 8 zone averages 18 grams per ton. It doesn't take a lot of 18 gram per ton material pulled up a shaft that already exists to really amplify the number of ounces that are coming out of an operating mine. There's the opportunity to extend the known zone to depth. We have lots of scattered historic hits down there that really suggest that it continues down there. So we're really excited to lean into that exploration opportunity, and that's going to become increasingly possible as we get through this work that needs to be done for the restart. We're going to be able to put more and more effort into the exploration.
This asset in the previous company was trading at roughly $1 billion. And so right now you guys are just north of
150 million.
Yeah, $150 million market cap, and you're doing all this work. What is the uphill battle that you're fighting? Like, compared to your peers, do you have many peers, many companies at this stage?
Yeah, so this is an interesting question. Like, what's the valuation potential here? We're trading at $150, $160 million right now. I think the easiest way to look at what this re-rate as we get into production, where that could or should take us, is to look at peer companies that produce ballpark 70,000 ounces per year. That's in line or conservative look at what the previous studies were. That's a reasonable number that you could get from an 800 ton per day mill. So what are 70,000 ounce per year producers in Canada from high grade ore bodies? What are they trading at? Well, there's a wide range, but it's really reasonable to think $500 or $600 million is where an operator of that scale should be valued in the market today. And that's not really leaning into a $2,400 gold price, but that's, that's a conservative, real ballpark for what a producer of that scale should be worth. Now, if we can expand to 100, 125,000 ounces per year. If we can get some excitement around the potential for the 8 zone, there's a lot of opportunity for that number to be a lot bigger. West Dome is the sort of great example of that. West Dome started at about the scale that I'm outlining right now. Then they found Kiena Deeps, which was a high-grade zone that made them able to increase their annual production significantly without a lot of capital expenditure, because it was just feeding really high-grade ore into largely existing infrastructure. And now West Dome is trading at, I think, $1.5 billion. So that's an arm-wavy look, but that is a reasonable comparable for the path that we are working to go down.
So then one last question, you kind of mentioned that in there, where you said that's not even taking into account $2,400 gold. How does the price of gold affect you? Like, I know there's a lot of people that buy gold as a store for wealth, as a safety for the future. Mm-hmm. But why does the price of gold matter so much for you guys?
I'd say there's sort of two ways to approach that question. The first is that the price of gold has done very well, in particular over the last few months. And it's done very well largely because of buying in China. That's the Chinese central bank and Chinese retail. And there's very real reasons why that is happening. The Chinese central bank is buying tons of gold, started buying tons of gold 2 years ago in the middle of 2022, as deglobalization and de-dollarization became very real things. The central bank decided that they needed to clearly diversify, hedge that risk, and they're doing it with gold. The Chinese population, around the same time, started to realize that the places that they had been putting wealth through their 20 years of explosive growth, which is a really phenomenal period in China, those places are not working anymore. The real estate market, the stock market, interest rates, those are not safe or high return places for Chinese wealth. So they're going through a paradigm shift, and the answer, one of the main answers that's coming out of that paradigm shift for Chinese wealth is the classic answer, which is gold. The explosion of gold buying on the Shanghai Exchange is just like, it's a chart that blows your mind. That this is why the gold price has moved. Now, I say all of those things because it explains why gold equities, why stocks in North America, gold stocks, haven't really responded to the rising gold price, not as much as you would expect them to. And the reason is, usually when the gold price rises, it's because North American investors are buying gold as a hedge to risk, to geopolitical risk or economic risk, because of inflation, because of interest rates. Those are the classic drivers. And when North American investors are buying gold, they buy gold stocks right alongside. So they move in sync. This time the gold move is happening from a different place. It's happening from China. And the North American investor has been taken a bit by surprise. Their focus, to generalize, North American focus has not been on gold. There have been a lot of other arenas in the stock market, AI obviously, but others that have, continued to hold their attention. But this rise in gold price is going to soon, when we get to the end of the second quarter, it's going to produce some profits at gold mining companies that all of the algorithms that creep through the internet looking for profit yields, dividend yields, they won't be able to ignore gold stocks. So I really think that we're about to see, come the beginning of August, when those second quarter results come out, late July and August, I think we're going to see generalist investor interest in North America turn sharply to gold stocks. That kind of move, when you have generalist money move into a small space, gold is a small space, the returns that can be generated are really significant. And West Red Lake Gold was built to take advantage of a new gold bull market. What I've just described are the details of how that gold bull market is playing out, but overall, this is a gold bull market. We're building a new gold company, and if you want to take best advantage of a rising gold price, you do it with new production, going from spending money to making money, and growing production, which is what we want to do after we get the asset into production. So we're really trying to position for the overall gold market, and then in a little bit more detail, this shift that's coming as North American investors will have to soon start paying attention to gold stocks because of that strong gold price.
Fantastic, thank you. So West Red Lake, WRLG. We'll keep an eye out for it. And any last questions or remarks?
I'm Gwen. I'm at West Red Lake. I'm happy to answer any questions that anybody has. I mean, I could talk about this stock all day, but yes, WLRG on the Toronto Venture Exchange. And yeah, happy to answer any questions.